Hello, I'm Barry Page, the host of Legacy Money, the show that shares the truth about money so you can live more, give more, and leave more. So this video is going to be short and to the point. It may sound repetitive if you've watched some other videos because I've covered all of this before, but it's worth repeating. Repetition is the mother of learning. Nelson said we should read this book every year. And it's just to help you understand how the financing actually works. Sometimes we overcomplicate things, so I'm just going to go over the real basics. I do get a lot of questions, and so I'm just going to go over everything again to help you grasp this concept. It's been a while since we made a video. I've been noticeably absent, so I apologize. We've been dealing with some personal family issues, so forgive us while we've been gone, but we're back at it today. And we're going to cover a question that I get frequently, and that is, why should I borrow from my life insurance policy? And why borrow my own money? And perhaps a lot of this is because of the entertainers, gurus out there that constantly tell you that life insurance is a bad investment, and that's a good thing because it's not an investment at all, as you're going to be able to tell today as I go through this presentation. So stay with us. I'm excited to share this with you, and let's get started. Creating your own banking system. Think about that. What if you had the ability to finance all of your major purchases, so you never had to depend on the banks when you needed access to capital? So in this episode, I'm going to be teaching directly from the book, Becoming Your Own Banker by R. Nelson Nash. If you have not read this book, it's imperative to you learning and practicing infinite banking. So on page 17 of the book, Becoming Your Own Banker, Nelson identifies the problem with financing. The average American family is spending over 30% of their income on financing costs. This could be interest, it could be fees, the cost associated with financing. The problem is that all these items are financed by other banking organizations. The volume of interest is the real issue, not the annual percentage rate. This diagram on page 26 of the 5th edition of Becoming Your Own Banker, which is copyright and trademarked by the Infinite Banking Concept, this diagram lays out the entire banking process. Banking is a process. It's not a product. Too many people get too hung up in the idea that we're using life insurance as the vehicle to fund and to build wealth. This is a process, and so it works just like a traditional bank does, all right? Premiums go in, illustrated right here. Premiums go into this pool of capital. This is the insurance company, but they insure thousands and thousands of lives. So all the premiums go into this money pool. The company has expenses to pay. They have death claims to pay occasionally. But what they do want to do is to pay dividends to the policy owners every year. So premiums go in, expenses and claims go out, and dividends go out. Now, on the other side of this pool, you'll see that there's loans and repayments. First in line to get a loan are the policy owners. They can borrow money against their life insurance policy, and they can set up their own repayment system. However they want to do it, they can set up the structure, their own repayment schedule. There really is no schedule, so the policy owner controls that. The insurance company also makes loans for mortgages. Typically, these are commercial mortgages, so there's less risk, and they make loans and repayments as well. but the policy owners come first in line before they can loan money out to others. There's also joint ventures, other business projects that are funded and repaid through this same pool of capital. So banking is a process, and it's all laid out in this diagram on page 26 of Nelson's book. When discussing financing, the very first principle that must be understood is that you finance everything that you buy. You either pay interest to someone else or you give up interest you could have earned otherwise. The alternative use of money must always be reckoned with, Nelson said, and that's called lost opportunity cost as well when you borrow money or you use your own capital. So that's directly from the book, page 21 of Becoming Your Own Banker. Dividend paying life insurance. This is the tool, the vehicle that we're going to use to finance our purchases. Now, in its purest form, life insurance provides protection for your family and loved ones while allowing you to meet your financial goals. Another component, though, is the savings component, and that's often overlooked. So mutual life insurance companies may also offer a dividend to participating policyholders. Now, mutual insurance companies are different than stock insurance companies, and they're among the most stable companies on earth. Actuaries work for these companies, and they work with rate makers, and they engineer these policies to perform over a long period of time. We're talking about typically over 100 years, or an average lifespan of 100 was used for many years until recently when these mortality tables were updated. Furthermore, these policies are engineered to become more efficient every year, regardless of what happens elsewhere. There's always variations in earnings, death claims, and expenses, which I showed you earlier in the diagram, but the goal is to be profitable. And so they engineer these accounts, these policies, for these circumstances and to provide a surplus. The surplus is referred to as a dividend, and dividends are not guaranteed, but once they're declared, they can never lose value. And most of the mutual companies have been around over 100 years and have been paying dividends consistently every year for 100 years. Okay, looking at dividend paying life insurance. Think of life insurance as an account, just like any other. The major difference is the policy owner has complete control over this account. This account provides multiple benefits. So first of all, the dollars that are put into this account, they're going to perform multiple duties. The first we just discussed, protection for your family or business in the event that you are not there. Savings that you can use to accumulate wealth, and it's liquid and easily accessible. Growth. This account is going to grow guaranteed every year. It's going to get better. It compounds every year based on dividends and other additions that may be put into the policy. So it's going to grow, and it's uncorrelated to the markets, meaning the stock markets or most things in the economy. So it's going to grow based on what the actuaries did in the beginning with the mortality and the time that the policy premiums are paid will all play a big part of this. But it's going to grow every year, guaranteed, and it compounds, which makes it even better. Now, then we have financing options to utilize without credit reporting at competitive rates. Meaning, you don't have to qualify, you don't have to fill out any Mickey Mouse paperwork, Nelson called it, to access the capital for a loan. So it has financing options. Your dollars are working overtime. Now let's talk about interest. Everybody gets caught up in the interest. And as I said in the beginning, Nelson always said the interest rate is not the problem. It's the volume of interest that we pay over time. So Here's how it works with a life insurance policy. The current cash value of a policy is available for loan at any time for any reason without having to qualify credit-wise. Underwriting was completed on the owner and insured when the policy was issued. Therefore, the owner has first access to the capital that is available. So again, think of the collateral or the cash value as collateral. Most people are familiar with collateral when the bank asks you, what do you have as collateral? The death benefit is used as collateral whenever you take a loan against the policy. Interest that is paid goes back into the pool of capital that all of the policy owners share in. And the principal payment, when they make repayments, goes back into this capital pool. The principal reduces the loan amount and the interest is paid to the insurance company, which makes all of this work. So simple interest is charged in advance every year on any outstanding loan balance. Now, this is a head scratcher for a lot of people because we're used to paying compounding interest. See, the simple interest is reduced as principal payments are made throughout the year. So this is typically due on the policy anniversary. It's charged in advance, and then it's due the following year or whenever that next policy anniversary is. Interest can be paid in many forms, including cash, loans, dividends. There's multiple ways that you can pay the interest. Just understand that the interest is due annually. In other words, you can pay interest just one time a year and not pay any principal. Or you don't have to pay either one. You can take a loan, or you can do, as I mentioned, any number of things to pay this interest, which is due once a year. So how do you pay? How to pay? How do you, if you want to purchase or finance something, what's the best way to pay? So insurance companies offer loan access with non-structured payments to the policy owners. But the policy can also act as a safety position. Maybe you didn't want to make a loan through the insurance company and you were going to secure a structured loan with a traditional bank. Well, that's the collateral. So other financial institutions, they might offer you a more favorable rate, a better rate. People get real caught up in this. They say, oh, well, the insurance company's rate is, 5% or whatever it is, 8%. And the bank, I can get a loan for 4%. Well, go ahead. Get the loan from the bank. If it's at a more favorable rate, you can use your life insurance still for the collateral. We don't necessarily always recommend doing that. You just want to read the fine print that the bank, understand, is in control of that scenario. So, but it's just another way to help you understand what the collateral part of the how the policy works. So either way, people get caught up and confused sometimes with the comparisons. We've been taught to pay cash for everything. So if we have it, and not to finance. So does it make sense to finance a loan when you can pay cash? Well, that's the question I'm going to try to help you answer here in a little bit. Just because a policy has cash value, though, that doesn't mean that we should take a loan. We should guard this cash value, this collateral, very carefully. So let's talk about EVA real quick. Economic value added. It's a trademark term of Stern, Stewart and Company. And EVA is used to measure the financial performance that attempts to capture the true economic profit of operating decisions. It's calculated by deducting the cost of capital from after-tax operating profits. So why is that important? Well, your capital has a cost. So as Nelson said, you finance everything that you buy, right? So your capital, if it's sitting somewhere not earning interest, it's costing you money. If you're not using it and you're borrowing money from somebody else, there's a cost to that. Considering your personal economy, the consumption cost of existing capital should be highly valued. So earlier when I said your cash value, your collateral should be guarded, you should put a high value on that. If you borrow the money borrow against the policy, you should repay it. You want to be an honest banker. And since policy loans are non-structured, sometimes it's easy to not repay the loans. We don't get a payment book. You don't get anything that says, hey, this amount is due this month, principal and interest. That's totally up to you. You get a statement saying you made a loan, and then you get a due notice on the entry on the interest on the policy anniversary. So the policy loan can be repaid at any time, at any rate, or any time frame that the policy owner chooses. Okay, so that's really up to you. If the insurance company is charging 5%, you can pay it back at 6% or 8%. That additional capital goes back into your policy and helps it to grow. Now, there's can be a lot of confusions with that, so you'll want to work with an infinite banking practitioner to help you understand it. But just understand that you set the rate and you set the term, or the policy owner does in this case. So additional capital, so in other words, if you paid back more interest than what was due, that can add velocity to the growth of your policy. It will shorten, probably because, again, the insurance company charges that once a year. So depending on how you repay, it could shorten that time frame, or it could, add additional capital into the policy. All right, talking about how to pay. Let's take a look at compounding interest versus amortizing interest. Now, I hope you can see this okay. I'll try to zoom in here just a little for you to see what we can do. All right, so let's look at an initial balance. Let's say you had $30,000 in an account, and that account is earning 4%. It doesn't matter what it is. It could be a CD, it could be a mutual fund. It's just an account. It could be the life insurance. We're just using a number here of 4%. You're not going to put any money in there, but what you're going to do is you're going to look out over 5 years. So this money is compounding every year. So at the end of that 5 years, there was $6,630 earned in interest. So that made the account now worth $36,630 after 5 years. Okay? Pretty simple, right? Compounding interest. Now, let's take a look at amortizing interest. So it's going to look pretty similar, but it's a little different. So this is sometimes hard to get our arms around. If we were amortizing interest, in other words, we borrowed $30,000 and we were going to pay that back at the same 4%, then our monthly payment would be $552 principal and interest. But there is a difference. So the difference here is what most people don't take into account is that lost opportunity cost, or the cost of the interest on the interest, right? So that's what this, so the red line, the lighter red line is the interest, okay? And the gold is the interest on the interest. So our total cost, the principal, interest, and the interest on the interest, right, because it's compounding over time, comes out to be $36,630. So as you see here, the numbers are the same, whether or not we compounded the interest or we amortized it by paying, right? So the numbers are the same. Now, I'm going to show you this in a spreadsheet just because people think differently, okay? And I want you to actually see the numbers. So again, I'm going to zoom in here. And we're still just comparing compounding interest versus amortizing interest. So right here, 4%, $30,000. We've got $1,099 of interest was paid the first year in this scenario. In the second year, we reduced, right, the loan amount, and so the interest goes down. and $874 were paid the second year, $640 the third, $395 and $141 the fifth year. Okay, here's the cumulative interest. If you added that together, $1,099 and $874 give you $1,973, and then you add the $640. So that is the cumulative interest after the 5 years, the $3,150. So let's look at what interest was earned, and that is $1,222 the first year. This actually stays a little more consistent because, again, it's a little different when we're compounding the interest. So $1,272 the next year, $1,324 the next year, $1,378. So it's not reduced too much, right? Because it's compounding. It's growing, the other is going down. So compounding is going up, the interest paid is going down. The cumulative interest earned is, as you see here, the $1,222 versus the $1,272. So now you have $2,494, and the $1,324 plus that $2,494 is $3,818, and on to the fourth and the fifth year. So after the fifth year, $6,630 was the total interest earned, as you see here, right? So this is just a spreadsheet of that, and this $3,150 plus you had the interest that would have been earned on that. So the interest differential cumulative is $3,480. So you can see that difference, and that's the interest on the interest. So if you added those two together, you're going to get the $6,630. The end of the year loan balance is as you pay down the loan, the $30,000, right? Every year is reduced, and the fifth year is paid off. So every year the loan balance is reduced, and in the fifth year the loan is paid off. Here is the end of year, the capital balance. It's growing, $31,222 on out to $36,630. Here's the payments, right? So $5,531 the first year, $11,287, $17,277. So for a total amount of $30,000. The amortization, principal at interest, right? So that should be red actually there. So the $33.40, and the amortization interest at interest is the $35.90. So there, and the total cost of ownership, again, the $36,630 is the same as the end of the year capital balance. All right, so another question that comes up, well, what if loan rates are higher? In other words, you're earning 4, but the interest rate is 6. Does it still make sense to finance? Well, it depends. It depends on the situation. It depends on maybe what you're financing. If it's a car, the car is going to depreciate and lose value. If it's another investment, perhaps a classic car that maybe is going up in value. I don't know, that still might not happen, but let's say something that is going to go up in value, maybe a house, right? So maybe a rental house, maybe something that's going to actually bring in income. So the cost of capital, in other words, paying 6% would be 2%. Right? If we're earning 4 and the cost is 6. So that's the 2% cost of capital in that situation. But what if this rental house, okay, is going to, or this house that you're buying is going to put money again in your pocket? Maybe it's a business. Who knows what it is? Sometimes it makes sense. So you just have to determine that, but that's the easy way to do it. And that's what the EVA kind of highlights to us, is that, again, we could pay more interest if it's going back into our system, right? Instead of paying 4, maybe we could pay 6. And then you add that to what you're going to earn as profits, and it's really infinite in that situation. So what if loan rates are higher? This spreadsheet is the same spreadsheet that I just looked at, but I do have the 6% on here, so I just want to kind of maybe zoom in on that a little bit. And of course, 6% on $30,000 is a little bit higher, 1656, but the annual interest earned is 1850. So principal interest is reduced here as principal payments are made, and the loan is reduced. There's our cumulative interest, the actual interest earned, and the cumulative interest earned. So there's the difference, 5666. There's the loan balance going to zero, and the capital balance growing. It would grow a little more, obviously, with 6%. And the amortization principal at interest, and again, that should be read. The interest at interest, so the total cost of ownership is the $40,666. But what I want you to note is in both of these, after the end of 5 years, let's just say you were buying a car, okay? Now, at the end of the 5 years, some people, they finance every 4 or 5 years, depending, on the situation. But other folks might drive that car for 5 years. So they get 10 years out of the car after it's paid for. That's what I do personally. And so in this situation, this balance, though, here in this account, maybe it's permanent life insurance, is going to continue to grow. And that's what you need to kind of get your understanding. This compounding is greater here now, and it's uninterrupted throughout this whole process. And again, if it grew by 6%, here's what that would be. So at the end of the 10 years, that account would have grown to 54,582. Had no more loans been taken. The loans were paid. So our capital is growing just as it would normally. So that's how that works. So we have to think a little bit here. If the cost is the same, whether we pay cash or finance it, which option gives you the greatest control and is the best decision for your current cash flow position? So again, like I said earlier, it just depends on the situation. It doesn't make sense to borrow money just for the sake of borrowing it. But if you have an emergency, if you have an opportunity, if you are making an investment into another asset that's going to increase in value and it can outpace what you're paying, then certainly it makes sense. So whatever your current cash flow situation is, and if you're a business owner, you of course know that cash flow can change month to month. All right, so it's all about control. Money flows through our hands to meet our needs, but somewhere in the process, it all ends up back in the banking system. It is all a matter of how much of the banking function do you control as it relates to your needs. Again, that's a direct quote from R&S on Nash, Becoming Your Own Banker, page 11 of the 5th edition. So controlling this banking function is what we're talking about. And that's what the infinite banking concept is all about. Finance. Just to kind of recap, wherever you are, the good news is you can change the picture. If you've got debt, if you have no debt, if you've got savings, if you're looking for a place to store capital, what better place to store it than your own private financial system? And you don't need to take unnecessary risk or use funny money. You can create your own private system and finance your major purchases just as you would normally finance with others. You just have to think differently. What about opportunities? I mentioned a rental house. I mentioned a business, any other asset. These are some examples of people who have used permanent life insurance for loans in their business. So think about the return of the opportunity. And we all know there are opportunities constantly. It's just a matter of the timing, having access to capital. And that's what this can do for you. So thank you for joining me today. Leave your questions and comments below. I'd appreciate it if you subscribe and give me a thumbs up if you like this video. And I'll see you in the next video.